Better System Trader, episode 67.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 67. Thank you very much for joining us today. We're going to get straight into this episode today because it's around 40 degrees here in Melbourne, which I think is probably around 105 Fahrenheit. I'm recording this in my office, but the fan's making an awful racket, so I've just switched it off for a couple moments, so we're going to move through this real fast. The guest for this episode is Jack Vogel. Jack is from Alpha Architect, which is a quantitative asset management and consulting firm. Jack's published a number of papers on SSRN and also co-authored a couple of books as well, including Quantitative Momentum, a practitioner's guide to building a momentum-based stock selection system, which is a book I read towards the end of last year. So I reached out to Jack after reading that, and he kindly accepted to come on the show and have a chat. Today we're going to be talking to Jack about momentum, and even though the context of the book and our discussion is around momentum investing, there's still a lot of ideas and market insights in there for traders as well, and I particularly found the concept of trend quality quite interesting, so listen out for that one. So anyway, let's get straight into our chat with Jack. Hi Jack, thanks for coming on the show. It's really great to have you here.
Yeah, thanks for having me on your podcast. Hopefully we can have a good conversation about momentum today.
Yeah, I've been looking forward to that. So before we do get into momentum, how about we start with a little bit of background on yourself?
Sure. So I started out in a roundabout way getting into the world of finance. My undergrad was math and education. I'm a certified high school math teacher, and went straight into a PhD in mathematics program. And 2 years into that, I realized I didn't really want a PhD in mathematics anymore. And I kind of switched to PhD in finance. And lo and behold, I met, when you're in a PhD program, you kind of work with one professor, kind of get assigned to them, and you do a lot of research and work with them on a day-to-day basis. And I got assigned with Wes Gray, who's the founder of our firm, Alpha Architect, and kind of have been working with him. Originally it was like academic research, and then Wes, he started the firm and kind of transitioned into more of a business type relationship. So that's kind of how I got into it. I did finish my PhD in finance. My dissertation is kind of on like empirical asset pricing, which is just examining how, past stock returns can be explained. And so that's kind of how I got into it. And as a firm, Alpha Architect, how did we start? As I mentioned, Wes Gray started the firm. We started out as a consulting firm for a billion-dollar family office in New York City. And for 2 years, we did a lot of research, basically tested almost every hedge fund strategy you can imagine. And then we decided to get into asset management, and we've been doing that since 2012. And we have around $400 million under management now, in a combination of our separately managed accounts as well as our ETF business.
Okay, great. So now you've published a number of papers on SSRN, and you've co-authored a book called Quantitative Momentum, a practitioner's guide to building a momentum-based stock selection system. Yeah. You've also published a number of blog posts on momentum on the Alpha Architect website. So I thought it would be great to have a chat with you today about momentum. You seem like a really good candidate for that. So do you want to just start with a couple of the basics in what actually is momentum?
Sure. So momentum investing, is a strategy that involves investing in securities in general that have had the best performance over the past year. There's different ways to measure momentum, but the simplest way is just say, hey, let's look at the total return of a stock over the past year. And so, a simple example would be like, let's say we have stock A that was worth $10 a year ago. pays no dividends, and it's worth $15 today. So it's up 50%. Stock B is worth $10 a year ago, and today it's worth 5%. So in our two stock universe, we have one stock that's up 50%, one that's down 50%. A momentum-based strategy would tell you to buy the stock that had the best performance over the past year. And if you want to build a portfolio of it, if you take 1,000 stocks, you would buy the top 100 stocks, or the top 10% or 20%. You could go 200 based on their past year return. So that's what is known in the academic literature as intermediate term momentum, where the firms that have done the best in the past have a continuation, and they continue to outperform those that have done poorly.
So I think it's kind of a little bit of human nature to want to understand why some kind of something is affecting momentum. So what do you think causes momentum in the markets?
So that's a great question. And academics have discussed it back and forth. On one hand, you have the risk-based idea, i.e. that these high momentum stocks are just riskier now. And that's why they have outperformed low momentum stocks. Potentially you could argue, hey, they're riskier because the price is much higher relative to some fundamental. Again, momentum's just on price, but from a risk perspective, you could say, hey, these are riskier. And that's the reason that they outperform. We are kind of fans of the behavioral approach, where academics have come up with neat models that have shown that and it's been shown then by looking at individual trade data that investors at times will actually underreact to good news. So, you have a firm that comes out with good earnings, but investors, or some sort of positive news about the firm, and investors may actually underreact to that news, which allows the stock price to continue to go up. So there's two reasons for why a momentum strategy may outperform, and historically, looking at the data, has outperformed. Risk and behavior. We tend to like the behavior explanation, but there probably is some merit to the risk-based explanation as well.
Yeah, cool. And I think there's often some confusion around momentum. So you've already discussed one type of momentum, but can you explain the classifications that you can use in momentum?
Yeah, that's a great question. So there's, I think have you had Gary on your podcast as well, Gary Antonacci? Yeah, so Gary's a fan of what's called dual momentum, i.e. there's two types of momentum. And it is important to clarify when you talk about momentum, what do you mean? So there's two types of momentum. There's what's called cross-sectional momentum, or a relative strength momentum. And basically what that is cross-sectional momentum is a measure of a stock's performance relative to other stocks. That's why it's called relative momentum. So if we had 1,000 stocks using cross-sectional momentum, a strategy using that would buy, let's say, the top 100 or 200, regardless of what the returns are, positive or negative. You just look at the past returns over a year, buy the top 100. Now, time series momentum, or what Gary will mention as called absolute momentum or trend, right, is based on a stock's own past return and is considered independent from the returns of other stocks. So what that means is, in our 1,000 stock universe, or let's say you have 10 assets, you would only, using a time series or absolute momentum rule, you would only buy a security that has had a positive return over the past year. So they are two different things. Cross-sectional or relative strength is looking at a group of assets or securities relative to each other, whereas time series or absolute momentum looks at assets and assets' own past return independent of other stocks in the universe.
Yeah, and I think those two different types of momentum have different impacts to a strategy. So can you explain the benefits of combining both of them together?
Yeah. So now what we like to do, and just to give you full context, um, our book Quantitative Momentum is mainly about cross-sectional momentum or relative strength. That's kind of the focus of the book. We do discuss the second type of momentum in we have a pretty big appendix chapter, and we actually spend 20 pages on that. So we discuss it in there, but in general, we talk about cross-sectional momentum. Now, how can these help each other from an investor standpoint? So let's pretend we'll do two examples. In one example, we are just going to buy U.S. stocks, right? And in this example, we can use cross-sectional momentum to, let's say, buy the top 100 stocks every month or every quarter. And what the whole goal of that is, one hopes to outperform the index using cross-sectional momentum, i.e. buying the top performing stocks in the past. Now, what a time series momentum or absolute momentum can do is you will say, hey, I will buy the top 100 stocks, but I will only buy them if the return to each of the stocks, because remember, this time series and absolute, you're looking at a stock's individual return. So you say, I will buy the stock only if the return to each stock is positive. And what that tends to do is, your trend or absolute momentum rule will, in general, help you to, lower drawdowns of a portfolio over time. And again, trend rules are not perfect. They tend to lower drawdowns, which is the goal because you go to cash or risk-free asset. However, the potential downside to a trend rule is you kind of get what's called whipsawed, where, the trend goes negative because there's some bad news and everyone starts selling, and then 2 weeks later, everyone's buying again. But so an investor can use two, one to pick stocks and another to try to time when to get in or out.
Yeah. So was there a particular reason why your book focused mostly on cross-sectional? I mean, that kind of approach can give you some pretty volatile returns and huge drawdowns. So was there a reason why just that particular style was a focus?
Yeah, so I think it's two reasons. So first reason is I think trend rules, or I think people, which is absolute momentum. I think people, in my opinion, they either like them or they don't, right? It's kind of, you either are a guy that likes to have trend rules in your portfolio, or you're someone that says, I can never time the market and I'm fully aware and I will just eat a 50, 60% drawdown because I know the market's going to come back. And so we didn't want to get into a huge argument about, trend rules within our book. Now, cross-sectional momentum, why do we focus on that? What we wanted to do is try to give a better explanation as to what is this thing called momentum investing when investors look and say, oh, I've heard momentum investing can be beneficial to my portfolio. So if any investors ever used a site like a portfolio visualizer just to examine or look at ETFs, there's loadings on value, size, the market, and then momentum. So what we wanted to focus on in this book and really explain to people was, what is momentum? How does one form a portfolio? Are there better ways to enhance a simple momentum strategy that I explained before, where you just pick the top 100 or top 10%? And then I think third and most importantly is we also wanted to explain how should one use a momentum strategy in a portfolio. Because Wes and I both grew up being, kind of Bible thumping value investors. But you come across momentum, which sounds kind of like heresy to a value investor, because what is momentum? Momentum is, it literally tells you to buy the stocks that have done the best. And if you're a Bible thumping value investor, you're like, well, wait a minute. My whole life, I've been just buying the worst stocks over the past year. So why would this momentum strategy be even beneficial to me? And that's why we wanted to focus on this, to educate people about momentum, show them how it can be beneficial in a portfolio, And really, because we came from value investors, show that a momentum portfolio is actually most beneficial to a value investor.
And how did you go transitioning from that, the belief in the value investing model to a momentum? It's quite a big shift in the thought process, I guess. So was there any challenges around accepting that type of research?
What I'd say is, and to be clear, we are still Bible thumping value investors.
Oh, okay.
Yeah,
Right.
it's not like we switched 100%. What we found, though, is that, hey, there are other factors that happen to work, right? And everyone in the investing universe, all that I feel like gets talked about is smart beta, right? And you have these factors. You got low vol, you got momentum, you got value, you got quality, you got, you name a factor and someone's going to make it up. And I agree. All of those factors, why are people making products about them? It's because in the past, all of those types of strategies seem to have worked. What we have come to the conclusion is that if we had to pick and build a portfolio to invest our own money, which we are doing, we would pick value and momentum. We think those are the two best factors long term. And momentum, and this has been shown in academic research, our research, if you take a momentum portfolio where you buy the top momentum and go short the long, we don't do long, do shorts in our portfolio, but just to rip out the market and compare that to a portfolio that's buys value stocks, shorts growth stocks, those two, what are called factors, i.e. the value factor and momentum factor, are negatively correlated with an extremely high T-stat. And so what does that mean for an individual investor? What that means is that if you have value investing and momentum investing, and even if they're long only, these two have a low correlation, i.e. value tends to work well at one time and momentum tends to work well at another time. And so let me give you a quick example, the internet bubble. So in the internet bubble, everyone knows value got destroyed, right? There was the front page of Barron's said, hey, Warren Buffett is losing his magic touch, right? And that's because Warren Buffett was losing to the S&P index and to momentum strategies by like 50% in 1 year, right? So in the internet bubble, if you were a momentum investor, that was great because you were just buying all the internet stocks. However, right after the internet bubble crashed, what happened? Value outperformed for the next 8 years. And what happens is if you look at a combination of a value and momentum, let's just say 50-50 in each, your overall portfolio beat the market over that time period. And again, that's why we wanted to focus in this book just on long only momentum investing, no trend, because we wanted to show people that momentum can be really beneficial to your portfolio, especially if you're a value investor.
Yeah. All right, thanks for explaining that, Jack. That was a really good example. So I just wanted to jump back to something you said a little bit earlier. When you were initially explaining momentum, you said you mentioned that you look at a stock, how it's performed over 12 months. So how does the length of that look back period actually impact returns over the long term?
Yeah, and that's actually a great question because let me explain. There's actually three types of momentum. So there's short-term momentum, which is like looking at the past month or past week or something like that. If one does that, you actually want to buy the low momentum stock. So in short-term momentum, which I'll classify as a month or less look back period, there's actually reversal in returns. Okay. Now, intermediate term momentum, which is what a lot of people think about, is if you look back from about 3 months to 15 months, anywhere in between. So some people like to do a combination where they pick 3, 6, 9, 12 and look at all the signals and rank on that. Now, in intermediate term momentum, what happens there is historically the top performers have what's called continuation of returns, where they continue to outperform. And now if one wanted to go even longer to the third type of momentum called long-term momentum, let's look at 5-year momentum. I'm going to look at the past 60 months and I'm going to rank stocks on their 60-month return. What happens there is actually a reversal. And what happens there is really that's kind of a value investing type strategy. Because, value stocks are the ones that have underperformed for a long time. So again, short term, which is a month or less, and long term, which is like 3 to 5 years or more, there's a reversal, i.e. you want to buy the worst ones. Whereas intermediate term, which is the focus of that book, from 3 to 15 months, there's continuation of returns, i.e. you want to buy the ones that have done the best over some look back period in between 3 and 15 months.
Okay, so that's interesting. So if the shorter period lookbacks are kind of mean reverting, does that mean that you should exclude the most recent month if you're calculating over a medium term?
That's what we do in practice, because there is this month-to-month mean reversion of stock returns. And if you include that month, you can somewhat confound your results, because you may be buying a stock that just had a great past month if you include the last 12 months. If you look back over the past 12 months and you include the last month, and let's say the stock just went up 100% in the last month, there is probably going to be a reversion the next month. So we exclude it. What I'd say, though, is if it's simple for investors to just look over the past 12 months, because it's sometimes trying to exclude a month for investors can be tricky given their data resources. The 12-month look back is okay. All else equal, though, you do want to exclude the last month.
Yeah. And you raise a really good point there, actually, because if you're looking at rebalancing or a look-back period, it's really just a point-in-time exercise, and it doesn't really take into account how the stock got to that point. So, as you mentioned, it could be a huge gap, or perhaps it's had a large run-up and it's on its way back down, but still has a higher reading than other stocks. So how do you kind of take that path into account?
Yeah, so we discuss this in the book, and it's one of our, I would say, enhancements to a momentum-based strategy. And what we do is, let's say we start with 1,000 stocks. We'll just do an example. Start with 1,000 stocks, and we say, hey, we're going to buy a top momentum stock. So we'll buy the top 10% or 100. Now, the simple question, and anyone who reads our book will see we've spent a whole chapter on it. A question is, hey, that's great that the top 100 seem to do well. Is there a way to pick, 50 or some number, a subset of that 100 that seems to outperform better? And so I'll give you an example. I think that kind of explains what we try to do, and then I'll explain the rationale behind it. So imagine we only have 2 high momentum stocks to pick. We have Boring Big Box Store, okay? And Boring Big Box Store is up 100%. And how it got its momentum is it was up 50 basis points for 200 days, right? So that's how it got its thing. Our alternative stock I'm going to call Exciting Biotech, right? And in Exciting Biotech, it was bouncing around, basically had 0% return. And then, last month, what happened? It got an FDA approval and it was up 100%. So these are clearly 2 stocks. They're both up 100%. One, Boring Big Box, just kind of was slow grinding up 50 bips every day. Exciting Biotech was kind of grinding all over, volatile, all crazy, jumps up 100% and then just stayed at 100. So the research and the question is, which one does well in the future? What we have found, as well as other academic studies have found, is that the Boring Big Box Store is one that is the stock that one should invest in. The title of this paper, which is really interesting for an academic paper, it's called Frog in the Pan, Continuous Information and Momentum. And the whole idea kind of examines that example I gave, Boring Big Box and Exciting Biotech. And the question is, and what their analogy is, what happens, if you put a frog in a pan of boiling water, if you throw it into boiling water, it jumps out. Whereas if you put it into a pan when it's cold and then slowly turn it up, it slowly dies, which is a sad story for the frog. But what the paper finds is that people tend to underreact to more continuous information. It's just a behavioral reason and a behavioral factor that affects returns. And it makes sense. So if you think of it, if you're boring big box store, right? Yeah, you're getting good news every day, but people are like, oh yeah, but it's boring big box store. Whereas for exciting biotech, they get their FDA approval. They're on CNBC. Everyone's talking about them. So in the future, and when they get these big news events, people are pretty good at pricing the assets. So in general, within the high momentum stocks, you want to focus on those that people are more likely to underreact to news about them. So we explain in the book how we measure it. We kind of look at positive and negative returns over the past year, and we pick firms that have more positive relative to negative. For an investor at home, another way to differentiate within your high momentum portfolio would be to look at lower volatility. It's kind of a similar type idea, not the same but similar.
Yeah. Okay, cool. Thanks, Jack. Now, let's have a quick chat about rebalancing. So if you're looking at a kind of like a medium-term look-back period, should that also match the period of rebalancing? And how does the frequency of rebalancing actually impact the results?
Yeah, again, another great question. And we spend, half of a whole chapter on this. Momentum is actually a strategy where one really needs to think about the rebalancing approach. So what we have settled on for a momentum-based strategy is that one really should do this quarterly. And how do we get to the quarterly number? We basically looked at the returns net of any transaction costs or fees, and we went from monthly rebalance out to annual rebalance, and we examined what happens if you change the rebalance frequency. And clearly, for a momentum strategy, if you can rebalance your portfolio monthly, you get the highest return, and it slowly dies off. Now, if one wanted to actually do a momentum rebalance annually, I'd highly recommend not doing that, or just picking another factor to invest in, because basically a momentum portfolio, if you wait a year to rebalance, after transaction costs and taxes and fees, you may be better off just buying the market there. So clearly you got to be somewhere in the middle. A lot of portfolios in the market are like 6 months, some are 3 months. We've settled on 3 months. We think that's the best. Clearly monthly before cost is the best, but there are costs to trading. So from our internal analysis, we settled on the quarterly number to rebalance our portfolio.
Yeah, I think there's probably a point at which the benefits of frequent rebalancing are overcome by costs. So where do you think that point is?
I would say it's somewhere in between. And again, what I'd say is it depends on the how much capital one wants to invest in it, and the ability and skill of the trader. I think if you had a small amount of money, you could do monthly and be fine. If you were very adept at, doing VWAP trades, being a provider of liquidity to the market. Whereas, if you said, hey, I want to trade 50 million or 100 million in a momentum strategy monthly, and we're going to do all these orders, market orders, you would get destroyed. So it's going to vary a lot across trading ability. What I'd say is what we settled on was quarterly. So, in there, we're assuming we're pretty adept at trading, but we also understand that even if we're decent at trading, it's still, we thought that was the best number, quarterly.
Yeah, okay. So in your book, it focuses on stock-based momentum strategies, but does that type of approach work for other markets and other asset classes?
Yes, it does. There's actually a great paper by the AQR guys. It's called Value and Momentum Everywhere. I highly recommend any investor that believes that you can not just index invest to read this paper. It's probably one of my favorite papers. And basically, what did the AQR guys? It's Asness, Moskowitz, and Peterson. They look at it and look at value and momentum across different asset classes, and they find that momentum appears to work across almost all asset classes, countries, etc. So what I say is, I generally don't send people to academic research papers if they're not familiar with them. However, I think this is one that's worthwhile for people to read.
Okay, cool. I'll get a link for that one and put it up on the show notes page so people can find that easily. Now, I think I heard you say before that you look at momentum for only strategies. Did I hear that correctly, or did I?
Yes, we don't do any individual shorting of stocks. In general, we so two reasons. One is just we're not running. So let me clarify that. We used to do some shorting of individual stocks. We've just moved to the point where, from an operational perspective, it's actually a lot easier to just short index futures against, say, your long strategy, if one wanted to take some sort of market or equity risk off the table. So one thing is operationally, it's a lot easier. Second thing is, embedded in a lot of shorting, there's like short rebates and a lot of other costs embedded in there, which we saw real time. This was probably 4 years ago when we were running our long short individual stock strategy. And we just came to the conclusion that there are benefits, which there could be, for us as a firm, were not larger than the potential cost of messing up a trade. And to be clear, what I'd say is, if we wanted to specialize in that, I think that could be possible. But you can't do everything in this world. So we just kind of punted on it, to be honest.
Yeah. Okay, so what do you think then that momentum, actually I probably should ask you, do you think momentum will continue to work over the long term, and why, if you think it does?
Yeah, so I think momentum can work over the long term. Personally, I have my money invested in value strategy and momentum strategy, which is stuff we do. So I'm kind of rooting for it. What I would say is that it's unclear when factors will work, and trying to time factors, I think, is very hard and can lead people down bad paths. What we see in the market is, over the past year and a half, low vol tended to be the best factor, which is great. But recently, since like the U.S. election, value has really come ripping back. So, could it be the time for value to be the factor to work? Could it be the time for momentum? I'm not sure. I do think it'll work long term, but I can't tell anyone really when that's going to happen.
Yeah, you can't whip out your crystal ball and give us a date?
I wish I could. Don't have that ability yet.
Yeah, okay, cool. So you've kind of touched on a couple of challenges of trading using momentum already, but can you expand on some of the issues that you face if you decide to be a momentum trader?
Yeah, so what I'd say is there's a couple issues if you want to do momentum the way that we outlined it in the book, which is highly concentrated, like 50 stock momentum portfolio. One, and this is a behavioral thing, is the portfolio that we kind of outline in the book, which historically did well, happens to have a lot of what we would call tracking error relative to an index. What do I mean by that? The S&P could be up 10%. You may be up 20. You may be down 10. And that's just going to happen from time to time. So investors need to understand that the more concentrated one wants to make a factor, which is what we like to do and why we make concentrated value momentum, because they tend to do well at different times. But if you're going to do it the way we outline it, you're going to have tracking error. So an investor could do one of two things. They can live with it and say, I'm all in, or they can say, I don't want to do that. And then as opposed to buying 50 stocks, you buy 250 stocks. And what happens there is you just look more like the index, and your performance should be more like the index. Now, the second thing, as you point out, is or a second potential issue for a momentum trader is the fact that I mentioned before, that you need to rebalance this thing really probably quarterly. So that's 4 trades a year. That can be onerous on people. You need to have ability to screen stocks on momentum. We actually provide a free link on our website under our tools section for all investors. We look at U.S. stocks and screen them on their past 12 to momentum. So there are some free tools out there, but some work is necessary, and you need to do it 4 times a year. If you're a value investor, you can go in late December every year and go from your 40 stock portfolio to the new one, and you're done for the year, because you can do value once a year. Momentum, you can't do that. It's a 4 times a year process. So I would say that's can be an onerous task if one wants to do the individual stock trading by themselves.
All right, cool. Thanks, Jack. One more question before we start wrapping up for today. Now, for someone who wanted to learn more about momentum, obviously they can go and buy your book, which is a great book. But what other steps can you recommend traders or investors take to get more experience with momentum?
Yeah, so besides the book, we actually, on our website, which is alphaarchitect.com, we have a ton of research and just white papers and discussions about momentum on there, and they're free. So I kind of recommend someone go there, and underneath our blog there is a section completely devoted to momentum investing, and I think one may want to just read that and see if they believe or are interested in momentum before they go straight to the book. Is probably what I'd say.
All right, thanks, Jack. Now I might start wrapping up with a couple of quick closing questions.
Sure.
What's the biggest lesson that you've learned through trading or /investing?
The biggest lesson is that the more concentrated your portfolio, the higher tracking error is going to be relative to an index. And a lot of times you can look at back test and see outperformance, but you don't see the tracking error month to month, which when you're running live money and it's other people's money and you have to explain that, that can be difficult. So what I'd say is, the more concentrated the portfolio, higher the tracking error.
All right. And do you have any favorite trading books?
As far as trading, probably. Let me think.
Or investing?
Yeah, investing. I mean, I'm kind of a Ben Graham. That was the first book I read, Intelligent Investor. That's one I always kind of go back to be honest. And I do like Greenblatt's Little Book That Beats the Market. That's kind of a value investing book. Gives a simple strategy and outlines. I'd say those 2 books from a value standpoint.
Yeah, cool. And what's the best way for listeners to get in touch with you?
So they can either put their email in through our website, alphaarchitect.com, or they can email me directly, which is Jack, Jack, at alphaarchitect.com. Awesome.
All right. Well, thank you very much for your time today, Jack. Is there anything else that you'd like to mention before we finish up for today?
No, I really enjoyed the time, and thanks for having me on.
Awesome. All right. Well, thank you very much again for spending time with us. It was really great to hear your insights on momentum. And so thanks again, and I wish you all the best.
Thanks to you as well.
Cheers, Jack.
Cheers.
Okay, thanks a lot for that, Jack. It was really great to have you on the show to have a chat about momentum. Now, if you'd like some more information, I have a bunch of links on the show notes page at bettersystemtrader.com/67, links to the articles that he referenced and some of the websites and books as well. So go check that one out, bettersystemtrader.com/67. Okay, now a big thanks for the people who have already shared a rating of this show on iTunes, but we do need your help to get more. So if you have just 30 seconds, please head on over to iTunes and leave a quick, honest rating review for the show. It'll be a really great help, so thank you very much. And also, if you have a topic or specific guest that you'd like to hear on the show, then feel free to email me, andrew@bettersystemtrader.com, or leave a comment on any of the show notes pages, and I'll see what I can do. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.